So this time they're going to have to raise money from bank reserves themselves, and bank reserves are going to plummet, I think, significantly below $3 trillion. And at some point, something is going to hit a snag, and then we're going to have an avalanche, and the Fed's going to have to reverse from QT to QE, cut to zero, bam, print $3-4 trillion in a matter of weeks. And at that point, I think the accounting worlds and the physical world are going to go their separate.
You're watching Silver News Daily. Subscribe for more.
Did you know that the banking system could be just weeks away from its breaking point? With bank reserves plummeting below critical levels and the debt ceiling crisis looming large, the risk of a financial meltdown is no longer just speculation. It's a ticking time bomb. But here's the kicker. While the system teeters on collapse, one asset could skyrocket in value and protect your wealth, Silver. Trust me, you don't want to miss what's coming next. As the signs are all around us, and they're impossible to ignore.
I like the account. I like finance a lot, no pun intended. Don't agree with him on everything, but on this particularly, I think he's completely wrong. His argument, in an isolated sense, makes sense. He's arguing that, okay, so interest rates are going to go up, and if interest rates go up, the price of bonds goes down, and when interest rates go up, that means the dollar gets stronger. And if the dollar goes stronger, then the Treasury could just like theoretically buy back all of its own debt, cancel it, and then we go back to zero and everything's fine and we start inflating again. I mean, that was the implication of it. So I agree with the technicals of that. It's theoretically possible that the value of U.S. debt goes down so much that the Treasury has enough dollars to buy it all back, and then cancel the debt. Okay, but then what happens in the wreckage of that? And Finance a Lot, he says this pretty explicitly. I don't remember the exact words he uses, but America goes back to its strong position, suggesting that the reserve currency status isn't affected and everything goes back to normal. And that's it. And by him saying that it's a genius move, he's saying that everything's going to be fine after that. The big problem with that, just in a very broad stroke sense, is that this is an accounting gimmick, right? And what he's saying in this tweet is that all that was wrong with all this money printing and this debt monetization and all the inflation that has led to all the wars and all the malinvestment, all the destruction of property and the destruction of wealth, it just depends how you count it, right? If you just cancel the debt and then buy it all back, then everything's fine, like nothing ever happened. And that's really the mistake that the Keynesians make and all the other academic economists make. That think they can control human behavior with equations. They think that, well, if you count the numbers in the right way and you do this and that and you massage things, then you can print as much money as you want and you can spend it on whatever you want. And the accounting world sort of like magically bleeds into the physical reality world, and you have this like magic potion. Right? None of that is real. Right? Accounting is a trick that we use to organize real.
As we dig deeper, let's talk about a vulnerability most people don't even realize exists: the fragile state of the banking system. At the heart of this issue lies a critical metric: bank reserves. These reserves are essentially the lifeblood of the financial system, the cash banks need to meet their obligations and ensure liquidity. But here's the shocking part. By the end of 2024, these reserves had plummeted to dangerously low levels, sitting just above $3 trillion, a threshold that, if breached, could trigger a financial crisis of historic proportions. Why does this matter? Let's break it down. Bank reserves are a buffer that protects against shocks, like sudden deposit withdrawals or financial market turbulence. However, with the government on the brink of raising the debt ceiling, the U.S. Treasury will need to raise vast sums of money to fund its obligations. And where will this money come from? You guessed it, bank reserves. Now, imagine this. As the Treasury pulls funds from reserves, the already strained system could be pushed past its breaking point. Banks would face mounting pressure, struggling to maintain liquidity. This creates a domino effect potentially leading to credit freezes, asset sell-offs, and a loss of confidence in the banking sector. We've seen what happens when trust in banks erodes. 2008 was a painful reminder of that. But here's the twist. It doesn't stop with the banks. If reserves fall too low, the Federal Reserve will have no choice but to intervene. Experts like Rafi Farber argue that the Fed might reverse its current course of quantitative tightening, QT where it's reducing its balance sheet, and instead shift back to quantitative easing key. This means printing more money, flooding the economy with dollars, and cutting interest rates to zero. And what happens next? Inflation explodes, the value of the dollar craters, and everyday people bear the brunt. This scenario is what Farber refers to as the separation of accounting reality from physical reality. Simply put, while banks and the Fed juggle numbers on paper, the real economy suffers the consequences. And in this chaotic landscape, one thing becomes abundantly clear. You need to find shelter from the storm. But what do you think? Are we on the verge of a financial meltdown, or is this just another chapter in the ongoing saga of economic instability? Share your thoughts below, and don't forget to subscribe, because in the next step, we'll unpack how the debt ceiling crisis could act as the catalyst for an economic earthquake.
What does it mean that the dollar is going to be weakening? It doesn't necessarily mean that the dollar is going to be weaker on a foreign exchange market. It could be stronger, but that is stronger relative to what? Well, it's relative to assets that are becoming worthless faster and faster and faster. So we could see, and I think we're going to see, the dollar become stronger and stronger on foreign exchange markets, and all the other currencies that are based on the dollar pour into the dollar itself. Because remember, other currencies are derivatives of the dollar themselves, and that's what the post Bretton Woods system has set up, right? The U.S. put, after it won World War, after it conquered the world, basically fiscally, it might not have conquered the world, in terms of placing its population all over the place. It sort of did do that, not entirely, but what it did do is it stuffed its dollars into every other central bank, so it conquered them monetarily, right? And so that makes every other currency a derivative of the dollar, essentially, because every other central bank owns dollars, and that's what gives them their value, and that's hard for people to accept. That's how it is. So we should see that's going back to the dichotomy between accounting and physical and real physical reality. We should see the world start to separate, right? As long as inflation remains muted in a way that the public isn't like koretegar. It's Hebrew. It's not calling out. It's not calling it out as a fraud yet. Then you can have the accounting world and the physical reality world sort of agreeing or looking like they agree, more or less, because people aren't checking. They're not checking their bunkers for what's actually there. But as these worlds separate, we should see the dollar get stronger in the accounting world, but get weaker and weaker in the real physical world. So the dollar index going up, but commodity prices going up even faster, then the dollar index goes up, and gold going up the fastest because it's the most liquid. That's what we should see. And that process, the separation of the accounting world from the physical reality world, where they reflect each other less and less and less, until everyone just says, like, the accounting world is fiction and forget it. Then they'll let the banks trade the foreign exchange. And then at a certain point, like, even the banks say, like, this is an accounting gimmick, and I can't really buy anything with my salary anymore. So then all the banks go into commodity futures and real assets, and then you have like the global rush into real stuff, which is led by gold and silver because they're the most liquid. This is how it happens.
Let's talk about the ticking time bomb everyone's watching, but few truly understand: the debt ceiling. The U.S. government has hit its borrowing limit once again. And while extraordinary measures are buying time, the summer deadline looms like a storm on the horizon. This isn't just a political football. It's a crisis in the making with global implications. Here's how it works. The debt ceiling is a cap on how much the government can borrow to meet its financial obligations. But, and here's the kicker, it's not about new spending. It's about paying for spending Congress already approved. Think of it as maxing out your credit card, then debating whether you should pay the bill. Sounds reckless, right? Now scale that up to a $36 trillion problem. As Treasury Secretary Janet Yellen scrambles to keep the lights on using accounting tricks, like delaying payments to government pension funds, the clock is ticking. If Congress doesn't act in time, the Treasury won't be able to issue new debt to cover its obligations. And this isn't just about government workers missing paychecks or delayed Social Security payments. It's about something much bigger: the credibility of the U.S. as a risk-free borrower. Here's why that's so dangerous. A default, even a brief one, could send shockwaves through the global financial system. Interest rates on U.S. debt would skyrocket, making it more expensive for the government to borrow in the future. But it doesn't stop there. The cost of borrowing for businesses and consumers would also rise, crushing economic growth. And let's not forget the ripple effects. Investors, spooked by the chaos, would likely flee to safer assets, real assets like gold and silver. Historically, these metals have been the go-to during times of uncertainty. Remember the 2011 debt ceiling crisis. Gold prices hit record highs as investors sought a hedge against the turmoil. But what's truly chilling is what Rafi Farber predicts. When the Treasury starts pulling funds from bank reserves to stay afloat, it could push reserves below critical levels, triggering a liquidity crisis in the banking sector. And once the dominoes start falling, there's no stopping the chain reaction. So here's the question. Is the debt ceiling just a political stunt, or could this be the tipping point that plunges us into a full-blown financial crisis? Drop your thoughts in the comments, and don't forget to hit the subscribe button. Next, we'll uncover why silver might be the ultimate lifeboat in these turbulent waters.
Currencies that are also worthless, but who cares if the dollar index is at like 300 if the dollar can't buy anything and nothing that the dollar can be exchanged for in the foreign exchange markets can be buy anything. It doesn't matter. Like, this is all a stupid accounting game where the physical reality is that nobody can afford anything. So that's the problem. Then you could ask, the question is, then why is that what happened in the late 1970s and 1980? Why is it that the dollar went up as interest rates went up? I mean, it was the high interest rate that saved the dollar. You could argue that. And, I'd sort of agree with you that Volcker hiked interest rates to 20%, and that's what saved the dollar. And we're on the fumes of the tank of that fiat gasoline today. So why did it work that back then? And why would it be different now? Well, the difference is that the interest rates are really high, but even though the interest rates are really high, the value of the debt was still solid because the U.S. could still afford to pay 20% interest rates in 1979, 1980. It was still doable, and investors knew that. Right? Real investors are like, wow, look at that, 20% interest rates on a treasury bond. Yeah, sure, let's buy that. 1980, 1981, gold looks a little bit overvalued here. I mean, it's $850 an ounce. It's like 130% of the Fed's balance sheet. We're already on a gold standard. So don't forget that like gold has had its time. Let's buy some treasuries, earn the interest. It's very attractive back then because the debt's 30% of GDP. It's manageable. It's a high interest rate. Yes, so let's lock it in. Let's get it. And so it's buyable and it's a good investment. But now, like, who thinks that the U.S. can pay 20% on a 10, 20, 30 year bond now? That's insane. It's not going to happen. Maybe they could in dollars that are worthless. And that's why gold's going to go up now as interest rates go up and not down. Right? So as interest rates go up, the dollar is going to weaken, not strengthen. It's going to be the opposite of what we saw in the late 1970s, 1980, except gold's going to go up much higher this time until
Now that we've laid out the cracks forming in the banking system and the looming debt ceiling crisis, let's shift our focus to a solution that has stood the test of time: silver. While fiat currencies wobble and the financial system faces mounting uncertainty, silver offers a beacon of stability. And here's why. Throughout history, Silver has been more than just a metal. It's been money. From ancient civilizations to modern economies, silver has played a dual role as both a store of value and a medium of exchange. And unlike fiat currencies, which are printed at will, silver is a finite resource. Its scarcity and industrial demand create a unique dynamic that makes it invaluable during times of financial chaos. But it's not just history backing silver's safe haven status. Look at the data. During the 2008 financial crisis, while markets were in free fall, silver surged. The same pattern emerged during the 2011 debt ceiling crisis, with silver prices climbing as confidence in fiat currencies waned. And today, with inflation rising and central banks hoarding precious metals, silver's role has never been clearer. Here's what makes silver particularly special right now. It's not just a hedge against inflation. It's also a critical industrial metal. As we move toward greener technologies, like solar panels and electric vehicles, silver's demand is skyrocketing. This means that while it protects your wealth during economic turbulence, its industrial uses drive long-term growth. But what about those who still see silver as a relic of the past? Critics often point to its volatility, arguing it's too unpredictable. Yet, as Rafi Farber points out, this volatility is part of what makes silver such an incredible opportunity. When markets are stable, silver may fluctuate, but in times of crisis, its price movements are anything but ordinary. We're talking about potential triple-digit growth as investors flee fiat currencies and rush into real assets. So let me ask you, when the next financial storm hits, will you be holding paper money that's losing value by the second? Or will you have silver, a tangible asset that has weathered every economic collapse in history? Think about it and let us know your thoughts in the comments. Don't forget to subscribe, because in the next step, we'll break down why hyperinflation could push silver's value to unimaginable heights.
Assets in the world, so we know that where they are and how much they are and how much needs we can actually satisfy with this real stuff on planet Earth. We use accounting in order to organize things. The thing is, you can lie about the accounting. That doesn't change the physical reality of what's going on. Right? So, like, imagine, Elijah, that you have money in your garage. Right? You have like gold coins, silver coin. Maybe you do. I don't know. I'm not saying that you do, but maybe you do. And you put me in charge of them, right? To like as your accountant, and I'm supposed to like give you a note about how much money in real assets. Let's not even say gold and silver. Let's say like wheat and barley and food, and, that you're stacking for an apocalypse. Let's make it real more realistic. That you're putting me in charge of your bunker for the end game, for the apocalypse, and I'm giving you a statement. And when I give you this statement, like I give you a piece of paper for every 1,000 bushels of wheat that you have, and another piece of paper for every 1,000 bushels of barley, and then for gold bars, et cetera, you have all this paper accounting. Right? And let's say you trade these things with your other prepper buddies who watch Reluctant Preppers and Liberty and Finance, and at least you have this like internal economy. But let's say like I'm actually stealing your stuff from your bunker without telling you, because you trust me, I have the keys, and you're trading all this paper, and you trade with your prepping buddies, and then when it comes down to it, and the SHTF, and you go down into your bunker, you realize that I took it all. Right? The accounting that you're pretending that you have all this stuff and you're trading these papers with your friends, it's not going to change the fact that you don't have anything. Right? So when things are really bad, all of a sudden accounting does not match with what you have discovered the physical reality to be, and you're just as screwed as you were when you were trading these papers around and getting assets from that trade. None of it was real, right? And then you experience hyperinflation, and then it's done, right? So that's just from like a broad strokes perspective. You can't pretend that accounting is what's real here, and it's the accounting that's the problem, and it's and the physical reality is not really connected to it. The other thing is you can explain it just more directly, more causally than that, and that is that the Fed's balance sheet is the dollar. It's the asset side of the dollar. The dollar is a liability, and what backs the liability is mostly treasury debt, about 93, 94%, if I got the numbers correct, right? Based on the fake valuation bold of $42 on the Fed's balance sheet. So if what mostly backs the dollar is the debt, if the interest rates go up on the debt and the debt becomes worthless, that means that 93% of the assets that back the dollar aren't worth anything. And so what is worth something on the Fed's balance sheet is the gold, right? So then the value of the gold goes up when the value of the debt goes down. It has to balance out, and then all the purchasing power goes to the gold holders anyway. But you can't have a situation, especially in an endgame scenario, where interest rates go up and the purchasing power of the dollar goes up. It might go up in terms of other.
If there's one term that strikes fear into the hearts of economists and everyday savers alike, it's hyperinflation. It's not just an economic concept. It's a reality that has wiped out savings, destroyed currencies, and plunged entire nations into chaos. And according to Rafi Farber, the U.S. may be closer to this nightmare scenario than most people think. Let's start with the basics. Hyperinflation occurs when prices spiral out of control due to excessive money printing. It's not just high inflation, it's inflation on steroids, where the value of money collapses so quickly that people rush to spend their cash before it loses more value. This is what Austrian economist Ludwig von Mises famously described as the crack-up boom, a terminal phase of monetary collapse driven by a loss of confidence in the currency. Now here's the scary part. Many of the warning signs are already here. In the aftermath of the pandemic, the Federal Reserve printed trillions of dollars to prop up the economy. While this flood of money initially kept things afloat, it also planted the seeds of an inflationary surge. Fast forward to today, and we're seeing prices rise across the board, from food to housing to energy. But here's where it gets worse. As the U.S. government continues to pile on debt and the Federal Reserve faces pressure to resume money printing through quantitative easing, the conditions for hyperinflation become even more likely. Remember, this isn't just about rising prices. It's about the dollar losing its status as a trusted store of value. And when that trust evaporates, the rush to tangible assets begins. Silver, as Farber points out, is poised to benefit the most in this environment. Why? Because unlike fiat currencies that can be printed infinitely, silver is limited by its physical supply. During hyperinflationary periods, real assets like silver and gold have historically skyrocketed in value as people desperately seek a hedge against their collapsing currency. Let's look at a historical example, the Weimar Republic in Germany. In the 1920s, hyperinflation got so bad that a loaf of bread went from costing a few marks to billions of marks within months. Yet those who held silver and gold were not only shielded from the chaos, but also came out ahead. Farber predicts a similar dynamic could play out here, with silver potentially surging to unprecedented heights. So here's the question. Are we already in the early stages of a crack-up boom? And if hyperinflation is the endgame for fiat currencies, what steps are you taking to protect yourself? Let us know in the comments, and make sure to subscribe. In the next step, we'll explore why Bitcoin may not be the safe haven some believe and why silver is the superior choice in a collapsing system.
Yeah, it's going to be on a bigger scale. It just depends. There is a sector somewhere that is weak. In 2023, the weakness was revealed in digital banking. This time it could be revealed in some other group of banks. Maybe like the big ones that have those large. I'm just guessing. I don't know. This isn't a prediction, but Bank of America has these large unrealized losses, which should be getting worse and worse because interest rates are going higher and higher. They just jumped like 10 basis points on Friday. So it could start in a very big bank, which could start a domino in all the other banks that have these large unrealized losses. So instead of Silicon Valley, it could be Bank of America. But I don't know. I don't know what it's going to be. But it's going to be something bigger, and it's going to spread. And the Fed is going to have to print or die, or print and die.
Now, let's dive into one of the hottest debates in the financial world. Is Bitcoin the future of money, or is it just another bubble waiting to burst? Rafi Farber has a clear answer, and it might surprise you. He believes Bitcoin is fundamentally flawed as a hedge against the coming collapse of fiat currencies. But why does he think silver and gold are the safer bets? Let's break it down. First, we need to understand the argument in favor of Bitcoin. Its proponents claim it's the digital gold, a decentralized currency free from government control and resistant to inflation due to its capped supply of 21 million coins. Sounds like a solid hedge, right? But as Farber points out, Bitcoin's value hinges on a fragile assumption that the digital infrastructure supporting it will always function. Here's the problem. Bitcoin exists entirely within the digital realm. It relies on electricity, the internet, and a complex network of miners and validators to operate. In a full-scale financial collapse or a severe geopolitical crisis, these systems could become unreliable or even inaccessible, and unlike gold or silver, Bitcoin has no physical presence, no intrinsic value you can hold in your hand. If the digital infrastructure falters, Bitcoin could lose its utility overnight. Contrast that with silver. It's not just a monetary asset, it's also a critical industrial metal used in everything from electronics to medical devices to renewable energy technologies. This dual demand gives silver a unique resilience. Even in a crisis where currencies fail, silver's physical properties and practical uses ensure it retains value. Another key point Farber makes is volatility. Bitcoin's price swings are infamous, with massive gains followed by equally dramatic crashes. While silver can also be volatile, its historical role as a safe haven asset has made it far more stable during periods of economic turmoil. Silver's price movements are driven by fundamental supply and demand dynamics, not speculative hype. And then there's trust. Gold and silver have been trusted stores of value for thousands of years. They've weathered countless crises, wars, and financial collapses. Bitcoin, on the other hand, has been around for just over a decade. Its short history makes it difficult to predict how it will perform in truly dire circumstances. So, what does this mean for you? Should you put your trust in a digital experiment or in the tangible assets that have preserved wealth for centuries? Think about it and let us know your thoughts in the comments. Don't forget to subscribe, because in the next step, we'll discuss how rising interest rates and stagflation could create the perfect storm for silver prices to soar.
Are starting this. They're going to start drawing money down from their checking account, which is not considered bank reserves, and that money is going to be spent down into bank reserves. So bank reserves are going to go a little bit up, and then the extra money is going to go back into reverse repo. And then what I think is going to happen is they're going to stay more or less stable, like around the $3.2, $3.3 trillion mark, up and down there by $100 billion every week, until the debt ceiling is raised. And when the debt ceiling is raised, all of a sudden you're going to see, like we saw last time in June 2023. What did it? Did they start falling in 2020? I think it started falling in June 2023. Yeah. What happened was that reverse repo started to fall as the Treasury started to sell more debt, and then banks took the money from the reverse repos and bought Treasury bills, and so the money went out of reverse repos into the banking system. And the thing is now, back then, like, the government could afford to do that without triggering some kind of catastrophe, because there was like $2.2 trillion stuck in reverse repos that could have been used. But now there's like 150 billion. It's basically zero. I don't want to call $150 billion zero, but like in the scheme of things, it's not that much. So there's not going to be any kind of buffer this time when the debt ceiling is raised and all of a sudden the Treasury goes from a $0 balance. And we all know, we've seen this before, the Treasury is not going to solve this problem is going to be solved until the Treasury's account goes very close to zero, and then all the politicians say, I got to save the country and raise the debt ceiling. They're going to raise it to whatever it's going to be, and then the Treasury is going to raise hundreds of billions, $500 billion, up to $1 trillion in short-term debt just to fill its account. And but where's that money going to come from this time? Last time it came from reverse repos. This time those dollars don't exist anymore because of QT. Right? They're all gone. So this time they're going to have to raise money from bank reserves themselves, and bank reserves are going to plummet I think significantly below $3 trillion. And at some point, something is going to hit a snag, and then we're going to have an avalanche, and the Fed's going to have to reverse from QT to QE, cut to zero, bam, print $3-4 trillion in a matter of weeks. And at that point, I think the accounting worlds and the physical world are going to go their separate ways.
Rising interest rates and the return of stagflation, two economic forces that many believed were relics of the past, are now front and center in today's financial landscape, and the implications for silver that could be game-changing. Let's start with interest rates. Over the past year, the Federal Reserve has been aggressively raising rates to combat inflation. But here's the twist. Instead of stabilizing the economy, these rate hikes are creating a paradox. While short-term rates have gone up, long-term Treasury yields have also risen, something that hasn't been seen since the stagflationary era of the 1970s. For those unfamiliar, stagflation is a toxic mix of high inflation, stagnant economic growth, and rising unemployment. It's the worst-case scenario for central banks, and it's looking eerily similar to where we're heading now. Why is this happening? Rising rates make borrowing more expensive, slowing down the economy. At the same time, inflationary pressures, driven by supply chain issues, geopolitical tensions, and money printing, are pushing prices higher. This combination squeezes consumers and businesses alike, setting the stage for prolonged economic stagnation. And here's where silver comes in. During the stagflation of the 1970s, silver and gold saw unprecedented gains. Investors turned to these metals as a hedge against inflation and a way to preserve their purchasing power. Silver, in particular, outperformed, as its dual role as an industrial and monetary asset amplified its value. Today, we're seeing echoes of that same dynamic. With inflation far from under control and interest rates threatening to stifle growth, silver is once again emerging as a go-to asset. But it's not just inflation driving demand. The industrial use of silver is surging, thanks to its role in green technologies like solar panels and electric vehicles. This creates a rare double benefit. While silver protects your wealth in the short term, its long-term industrial demand promises significant upside. Here's another factor to consider. Rising interest rates are putting pressure on the federal government's ability to service its massive debt. As borrowing costs climb, the likelihood of another round of quantitative easing key increases. And we know what that means. More money printing, higher inflation, and even greater demand for tangible assets like silver. So let me ask you, do you think the Federal Reserve can navigate this tightrope without plunging us into another economic crisis? Or are we already headed for stagflation, with silver as one of the few lifelines left? Drop your thoughts in the comments below and make sure to subscribe. In the next step, we'll explore how central banks are quietly hoarding gold and silver and what that means for your investments.
So what I'm tracking, I'm always looking for the proximate trigger for what is going to lead to this avalanche. I think where I think we are now is like the snow is ready. It's like stacked there. And, you just need like one stone to like throw at the right angle, and then a whole avalanche comes down, and the skiers are in trouble. So I think I'm looking for where the weak spot is that's going to cause the avalanche. I think we're like one stone's throw away. And what I'm looking at is the bank reserves level of somewhere below $3 trillion, which is where the last bank crisis was triggered. So, I think it's a safe it's a safe bet. I'm not saying place a bet, but I'm saying it's a safe inference that the $3 trillion bank reserves level should trigger something when it's hit again. And we did hit it on the year-end term. We hit it at the end of December, which is expected because that's when banks take all their extra cash and they just like stuff it in the Fed, so that it's not on their balance sheet, so they look nice and skinny, and that like reduces their fees for whatever regulatory reason. So we did see bank reserves fall below $3 trillion very briefly. But then again, it took several months, like 2 or 3 months of a reserves level below $3 trillion trigger the regional banking crisis. So we need to stay below $3 trillion for a while, maybe a few months, before something really big starts to happen. So what's happening now is that the debt ceiling has been hit, right? It can't raise any more debt, meaning the Treasury, what that means mechanically is the Treasury cannot suck any more money out of bank reserves to itself to spend. So what they're going to do is what's going to happen is they're going to start drawing money down, and they're already.
While the headlines are dominated by debates over inflation and interest rates, there's a quieter story unfolding behind the scenes, one that speaks volumes about the future of our financial system. Central banks around the world are hoarding gold and increasingly silver. But why are they doing this, and what does it mean for everyday investors? Let's start with gold. Central banks added a staggering 30 million ounces to their reserves in 2024, and the trend shows no sign of slowing. This isn't just a speculative move, it's a strategic shift. Central banks understand something crucial. As the global economy becomes more unstable and trust in fiat currencies erodes, tangible assets like gold offer unparalleled security. But here's the twist. Silver is now catching their attention too. Historically overshadowed by gold in central bank reserves, silver is starting to gain recognition for its unique properties. It's not just a monetary metal. It's an industrial powerhouse. As the world transitions to greener technologies, silver's demand in sectors like solar energy and electric vehicles is skyrocketing. Central banks see this dual role as an opportunity to hedge their reserves against both economic and industrial volatility. Why is this happening now? The answer lies in the fragility of fiat currencies. With countries like the U.S. grappling with skyrocketing debt and runaway inflation, central banks are preparing for a possible shift away from the dollar as the world's reserve currency. By stockpiling gold and silver, they're insulating themselves against the chaos that could follow. Here's an example. China and Russia have been aggressively increasing their gold reserves, and analysts speculate that silver could be our next target. These moves aren't just about diversification. They're a signal of declining confidence in the current monetary system. Central banks are positioning themselves for a world where fiat currencies may no longer dominate. What does this mean for you? It's simple. If central banks, the very institutions that print money, are turning to gold and silver as safeguards, shouldn't you be doing the same? Their actions validate the importance of these metals as a hedge against financial uncertainty. But here's the burning question. As central banks quietly buy up precious metals, could this lead to a supply squeeze, driving prices even higher? And are you prepared to secure your share before the window of opportunity closes? Let us know your thoughts in the comments, and don't forget to subscribe. In the next step, we'll delve into how investor behavior is shifting during inflationary periods and why silver is becoming the ultimate refuge.
Look, I've said the bubble's popping before. I don't know. I mean, I don't know if all I know for sure is that it is a bubble, because it doesn't make any sense that after the dollar is dead that anyone would be using this stuff. I mean, I've heard so many arguments, and none of them make any sense to me, because money has to be a commodity. It has to be. Logically, there is no other option. And look, we've seen so many stories of bubbles before. It's happened so many times, and every time people get hurt. Smart people get hurt, and rich people get hurt. I think Isaac Newton was even one of the. He was one of the guys who got hurt in the John Law bubble. Am I getting that right? I'm not sure. Maybe I'm getting the times off. But like Isaac Newton, who's like one of the smartest people ever, and from who we have in Newtonian physics and the understanding of our reality as we know it until we get to quantum. But that's a different story. But like people get hurt from these things, and they happen when there's a lot of money printing. And so there's a lot of money printing now. And then there's this new thing called Bitcoin. And what is I know it's a thing. I understand it. Like people say, "Oh, Rafi doesn't understand Bitcoin." I get the point. I get the point. It's a ledger, but okay, this is going to pop, and you can already see as the market wobbles and as interest rates wobble and as the assets that back the dollar, debt backs the dollar because of the balance sheet, and the dollar backs Bitcoin, even though you will deny that it does, right? Because Bitcoin is on the chain and you got to go back in the chain and it's got to eventually go back to a commodity. There's no stopping that. That's the regression principle. That's the regression theorem, or however you want to put it. This is going to pop. I have said in the past that I think the top was in at about 37 ounces of gold. There was a marginal break of that maybe 6 or 7 weeks ago to 39 ounces of gold for like a few hours. And now it's pulled back down. So what we have now on the technical charts, at least, is a marginal break of a double top and a reversal, which if you're into technical analysis is a very bearish chart. And if you want to pull that into Austrian style interpretation, buyers would go in on what looked like to be a break of the double top to try to push momentum, and then the reversal of the momentum means that the people who pushed it above from 37 to 39 ounces of gold, they ran out of ammo, and they don't have any more, and now they're hoping that somebody else pushes it past the double top. But what we have now looks like a triple top, and that's pretty bad. Could Bitcoin go higher from here? Yeah, but it's going to pop when the dollar dies. That I'm sure of. When there's no more dollar, there will be no more value in Bitcoin. Blockchain, maybe. Bitcoin, nah.
Let's talk about what happens when investors lose faith in fiat currencies, a phenomenon we're already beginning to witness. As inflation surges and governments pile on debt, the value of paper money erodes, leaving investors searching for alternatives to preserve their wealth. And guess what they're turning to? Tangible assets, with silver emerging as a standout choice. Here's why this flight from fiat currencies is gaining momentum. Historically, fiat money relies entirely on trust. It's backed by nothing but government promises, which lose credibility when inflation spirals out of control or fiscal policies become unsustainable. We've seen this before in places like Zimbabwe and Venezuela, where hyperinflation turned national currencies into worthless paper. Investors who had their savings tied up in fiat suffered catastrophic losses, while those holding real assets like silver and gold emerged unscathed. Today, we're seeing similar warning signs globally, with the U.S. dollar under pressure from rising debt levels and geopolitical tensions. Savvy investors are reallocating their portfolios. Precious metals, particularly silver, are becoming the go-to choice. Why? Because silver offers both monetary and industrial value, making it uniquely positioned to thrive in an inflationary environment. Let's break it down further. Inflation eats away at the purchasing power of fiat currencies, making every dollar you hold worth less over time. Meanwhile, silver retains its value because it's tied to real-world demand. It's used in technologies ranging from medical devices to solar panels, ensuring a steady need for this metal even when other investments falter. And here's the kicker. As more investors pivot to silver, the demand skyrockets while the supply remains limited. Unlike fiat money, which governments can print endlessly, silver is a finite resource. This imbalance is what drives prices higher, creating a self-reinforcing cycle of demand and appreciation. But let's address the skeptics. Is silver really the safest bet in a financial crisis? The data speaks for itself. During times of economic instability, silver has consistently outperformed most other asset classes, providing a reliable hedge against inflation and currency devaluation. So here's the question. Are you willing to watch your purchasing power dwindle as inflation eats away at your savings, Or will you join the growing wave of investors seeking refuge in silver? Share your thoughts in the comments below, and don't forget to subscribe. In the next step, we'll uncover silver's unique dual role as both a monetary and industrial asset, and why that makes it an unmatched investment opportunity. Let us know your thoughts in the comments, and don't forget to subscribe. In the next step, we'll delve into how investor behavior is shifting during inflationary periods and why silver is becoming the ultimate refuge.
I hear, people like Peter Schiff making these kinds of comments, and I can't say that they're wrong, but like things like, long-term bond investors, they don't believe that the Fed can pay it back, or sorry, that the Treasury can pay it back anymore. They're worried about inflation. I guess that's true, except, the institutions that are buying, right? It's not like they're making investment decisions like individual human beings would. They're part of this huge system, this huge machine that just like chomps up liquidity, spits it, chews it up, spits it out somewhere else, and and it's like grist for the mill. So like the question more is like, what are these individual investors thinking? Because we're talking about like huge banks here, or huge central banks that are the indirect bidders on these securities. Like, what are they thinking? Why is the machine being clogged now? And I can't say it's any individual's choice. You have to look at it more mechanically, and I haven't exactly worked out like how could you describe in an Austrian economic sense, where you want to always get down to the human level. How do you describe a huge machine like this, where there's no single actor with individual desires, maybe these $100 billion bond auctions that are making decisions? What's going on here? It could be that foreign denominated debt, what keeps foreign central banks buying these bonds or buying dollar denominated debt? I mean, it could be foreign central banks are trying to break their relationship with the dollar. It could be political decisions like that, or that just could be exacerbating it. I mean, I'm probably going to write an article about this if I think about it more, about what exactly is causing this giant machine to clog up. And I can't really answer it right now, but this is a monster, and it's got indigestion, and we know that was going to happen. So just get out of the way here.
Silver's unique dual role as both a monetary and industrial asset sets it apart in the world of investments. While gold often gets the spotlight for its safe haven status, silver offers a combination of stability and growth potential that is unmatched. Let's unpack why this metal holds such a pivotal position in today's economic landscape. First, its monetary role. Like gold, silver has been used as money for centuries. It's a tangible, finite asset that can't be printed or artificially created, making it a trusted store of value during times of economic uncertainty. In every financial crisis, silver's value has surged as people sought to protect their wealth from the erosion of fiat currencies. But silver is more than just a hedge. It's also an industrial powerhouse. It's a critical component in technologies that are shaping the future, from solar panels and electric vehicles to medical devices and electronics. In fact, over 50% of silver demand now comes from industrial applications. This dual demand, both as a safe haven asset and as a crucial industrial material, creates a rare dynamic where silver benefits from both economic turmoil and technological progress. Now consider the current market conditions. On one hand, inflation is driving investors toward hard assets like silver. On the other, the global push for renewable energy is supercharging industrial demand for the metal. This 1-2 punch is creating a perfect storm for silver prices to rise. But here's something even more compelling. silver's accessibility. Unlike gold, which can be prohibitively expensive for many investors, silver offers an entry point that's affordable while still delivering significant upside potential. Whether you're buying coins, bars, or ETs, silver provides a way to diversify your portfolio without breaking the bank. Yet there's a critical challenge: the supply-demand imbalance. Silver mining can't keep pace with the growing demand, and as central banks, industrial sectors, and private investors all compete for a finite resource, prices are poised to climb even higher. So let me ask you, in a world where fiat currencies are losing value and industrial demand for silver is exploding, can you afford to ignore the unique opportunity this metal presents? Drop your thoughts in the comments and hit that subscribe button. Coming up in the final step, we'll tie it all together: how the banking crisis, hyperinflation, and silver's growing demand could lead to a price surge unlike anything we've ever seen.
Yeah, I think what I said was, I think I was quoting Wolf Richter, who's also he's a really good, financial reporter, pretty good on government stats and stuff like that. So, if he was saying that he's not sure if this has ever happened before, that interest rates have risen 114 basis points from the bottom since the Fed cuts started, right? And so the Fed has cut 100 basis points, but the long term, the 10-year, 20-year, 30-year notes and bonds have gone up. I think he said 114 basis points. I think it's higher now. I think it's like 120, 130. And he said he wasn't sure if this has ever happened before, and he's right. It's never happened before to this extremity, but we have seen in the past, in the 1970s, where the Fed was cutting, and during that time overall, they were cutting the Fed funds rate, but the long-term treasuries were falling in value, meaning long-term interest rates were still rising, not as sharply as they are now, but it was happening. That was 1974 to 1975. That was the meat of a bond bear market, and now we're just at the beginning of a bond bear market, which started in 2021. So that was only 3 years into it. And in 1975, I think the last bond bear market started in 1946, if I'm not mistaken, and it ended in 1981. So at that point, we were about close to 30 years. 46, which is 60 to 7, a little bit less than 30 years into the bond bear market. This time we're like 2-3 years into it. We got a long way to go. It should be scary for people who own, 10, 20, 30-year debt, to be at the, 3 years into a huge bear market. And these bear markets usually last many decades, and we just started one. So you might want to get out of your long-term debt and get some real assets, which is what's going to happen. And it's going to be a steal.
We've explored the cracks in the banking system, the looming threat of hyperinflation, and the relentless demand for silver from both investors and industry. Now it's time to connect the dots and understand why all these factors point to one conclusion: a massive surge in silver prices is not just possible, it's inevitable. Here's how it all comes together. The fragile state of bank reserves and the debt ceiling crisis are setting the stage for economic instability on a scale we haven't seen in decades. As trust in the fiat monetary system erodes, central banks are quietly stockpiling gold and increasingly silver. This isn't just a hedge. It's preparation for a future where fiat currencies lose their dominant position. Meanwhile, the inflationary pressures unleashed by years of excessive money printing are eating away at the dollar's purchasing power. With central banks likely to resort to more quantitative easing key to stave off economic collapse, the dollar could spiral further into devaluation. And when that happens, history shows us exactly where investors will turn: to tangible, finite assets like silver. But it's not just about monetary protection. Silver's industrial demand is surging thanks to its critical role in green technologies and electronics. This dual demand, both as a safe haven and as an industrial necessity, creates a unique dynamic where silver thrives, regardless of broader economic conditions. Here's what this means for you. Analysts like Rafi Farber predict that as these forces converge, Silver prices could reach levels previously thought impossible. We're not talking small gains. We're talking about silver potentially doubling or even tripling in value as the flight from fiat currencies accelerates and industrial demand soars. But timing is everything. With central banks hoarding metals, investors snapping up silver to hedge against inflation, and industrial sectors competing for a limited supply, the window of opportunity to secure silver at today's prices is closing fast. So the question is, will you be ready when silver takes off? The signals are clear, the trends are undeniable, and the time to act is now. Thank you for watching, and if you found this discussion valuable, make sure to subscribe for more insights like these. Remember, this is not financial advice, just a guide to navigating the turbulent waters ahead. Stay prepared, stay informed, and we'll see you in the next video.